Our next guest was just named Domestic Stock Fund Manager of the Decade by Morningstar. In fact, his Fair Home Fund earned a 13.2% 10-year annualized total return through the end of 2009. That's impressive because it beat the S&P by 14 percentage points. He's here to tell us how he did it. That's Bruce Berkowitz of the Fair Home Funds. He's president and portfolio manager. Bruce, how did you do that?
Well, we do it by basically ignoring the crowd and going towards stressed area that many people are running from, and we make our judgments based upon the cash that securities generate. Value investing is all about comparing what you have to pay in cash.
Sir, I'm sorry, I'm going to have to jump in and cut you off. President Obama is approaching the podium. We have to go to him. Please stick around. We want to come back to this conversation. Bruce, I'm sorry I had to cut you off there. The president spoke a little bit earlier than we had expected him to. Before we went to the president, you were saying that you were able to post returns over the past 10 years by ignoring the crowd. Specifically, what were those moves?
Well, we stayed focused on positions and securities that were generating significant cash. For instance, we stayed away from the financial services sector during the calamity because we couldn't count the actual cash that these companies were generating. Much of it ended up being fictitious. We went towards very stressed areas. We tend to go towards areas where there's a great amount of fear, and we start to get a bit greedy, such as healthcare. We were very much focused on the healthcare insurers for a company such as Humana, and that's the way we do it. We keep it simple. We count cash. We see the cash that a security can generate for its owners, and if it's good in relationship to the price we have to pay, we buy.
Well, now that we're in this new decade, we just restarted here, are you still carrying through that practice of buying companies with a lot of cash on their balance sheets? What comes to mind when you say that is what we're seeing in the retail space, a lot of cash on hand there.
Well, we're a very large owner of Sears. We've been an owner for Sears for quite a bit of time, and we still have quite a large position in Sears, and there's still much to do. We're beginning to come out of a very stressful period. Stress creates cheap prices.
Can I jump in here, Bruce? Because Sears, sure. Which is run essentially by Eddie Lampert, the hedge fund managers, is assumed to have a so-called Eddie premium, that because he's associated with managing it, that's what's helping to bolster the stock price, because sales haven't been stellar. They may have bottomed out recently, but they haven't been strong. So what makes you confident in Sears?
Well, when we look at investments, we try and turn the question around and figure out how we could possibly get hurt with an investment as opposed to how much we're going to make. And when you take a look at the real estate, the brands, the services, the balance sheet, when you look at how much cash the company has generated during a very difficult time for Sears, which is related to the housing market, they've done quite well, better than most people think. And with an upturn in the economy, Sears should follow.
So it's not a bet on the upside to sales. It's how best they could manage any kind of downturn there with the cash they've got on hand. Is that what you're saying? And does this apply to some of your other picks?
Right. What I'm saying is right now you're getting Eddie Lampert's future for free.
All right. Well, what else do you like here?
I said we have healthcare, real estate, all the areas that have been hit hard, either because of the recession, because of the administration. So as I said, we like Humana, the company's price fell off a cliff when there were thoughts about the industry being nationalized, and that obviously is not happening now. And of course, there's tremendous stress in financial services, and they are beginning to recover. So the financial services sector looks interesting. Health insurers look interesting. Real estate companies such as St. Joe, smaller REITs such as Winthrop Realty. There's still reasonably good values out there, and there's still a lot to do. So we're excited about the positions in our portfolio for this year, and we're excited about this new decade.
How much cash are you going to keep on hand versus last year?
We always have a lot of cash. I mean, cash becomes extremely valuable when few have it. And cash, in some ways, is a financial Valium. It allows us to deal with very stressful times. It allows us to take advantage of cheap prices without having to sell anything. It gives our shareholders the liquidity. Mm-hmm. So we always have a lot of cash, and thankfully we have great shareholders who have stayed the course with us while many other funds have seen significant capital withdrawals. So I can't thank our shareholders enough.
So we recently had John Brennan of Vanguard on this program, who was talking about concern that perhaps there might be a push towards turning 401ks into annuities, some momentum there coming out of Washington. Are you seeing any kind of concern from your clients that perhaps they should be moving away from mutual funds in their 401ks?
We continue to see inflows. We've just started a new focused fixed income fund for those who want to focus on income generation as opposed to capital growth. But we're not seeing it. Our job is basically just to improve people's wealth, and we'll do it anyway, as long as we can do it. We don't lose any money for our shareholders, and then we make them some.
Okay. All right. Well, thank you so much, Bruce Berkowitz of the Fair Home Fund, for joining us here first on Bloomberg and for sticking around when we went to the president.